quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most people come into trading with completely the wrong idea of what success actually looks like. They believe it is about making money quickly, finding a perfect strategy, or somehow beating the market through intelligence alone. And this is exactly why the majority fail. Because what it really takes to succeed in trading is not what is marketed, not what is popular, and not what most people are prepared for. The reality is far more demanding. Success in trading is built on discipline, patience, emotional control, and a deep understanding of risk. It is a profession that punishes shortcuts and rewards consistency. It requires a mindset shift that very few people ever truly make. This is critical to understand from the beginning. Trading is not a get-rich-quick opportunity. It is a performance-based profession, much like elite sport or high-level business. And just like those fields, success is earned over time through structured development, not random effort. Now here is where most traders get it wrong. They focus almost entirely on strategies. They spend months or even years jumping from one method to another, believing the next one will finally unlock profitability. But the truth is, strategies are only a small part of the equation. The real difference between losing traders and consistently profitable traders lies in how they think, how they manage risk, and how they execute over time. In this video, the goal is to strip away all illusions and show exactly what it takes to succeed at a professional level. Not theories, not hype, but the real foundations that determine whether a trader survives or fails. By the end of this, there will be a completely different understanding of trading. Not as a gamble, not as a shortcut, but as a structured, disciplined profession. And that shift in perspective is the first step towards real success. To understand what it really takes to succeed in trading, it is necessary to first redefine what success actually means, because most traders measure success in the wrong way, and that alone leads to failure. Success in trading is not about how much money is made in a single trade, a single day, or even a single month. It is about consistency over time. It is about the ability to execute a process repeatedly with discipline regardless of short-term outcomes. This is where the psychological challenge begins. Human nature is wired to seek immediate rewards. People want quick results, fast validation, and visible progress. But trading does not operate like that. In trading, even perfect decisions can lead to losses in the short term, and imperfect decisions can occasionally lead to profits. That disconnect creates confusion, frustration, and ultimately poor decision making. This is why professional traders think differently. They do not judge themselves based on individual outcomes. They judge themselves based on process. Did they follow their plan? Did they manage risk correctly? Did they execute with discipline? These are the metrics that actually matter. Now this is critical. If success is defined incorrectly, behavior becomes destructive. Traders start chasing profits, overtrading, increasing risk, and abandoning their rules. And over time, that behavior guarantees failure. But when success is defined correctly, everything changes. The focus shifts from outcome to execution, from profit to process, from short-term emotion to long-term consistency. And this shift is not easy. It requires a complete rewiring of how decisions are made. It requires accepting uncertainty, embracing patience, and letting go of the need to be right. This is the foundation of professional trading. Without it, nothing else works. And with it, everything becomes structured, controlled, and sustainable. At the core of trading success lies one principle that overrides everything else, and that is risk management. This is not just important, it is the entire foundation of long-term survival and growth. Most traders underestimate this completely. They believe risk management is something secondary, something to think about after finding a strategy. But in reality, risk management is the strategy. It determines whether a trader stays in the game long enough to succeed. Now, this is where the harsh reality comes in. In trading, losses are guaranteed. There is no strategy, no system, and no trader who avoids losses entirely. The difference is how those losses are handled. Amateur traders try to avoid losses. Professional traders accept them and control them. This is a fundamental distinction. Trying to avoid losses leads to hesitation, emotional decision making, and poor execution. Accepting losses, on the other hand, allows for structured risk control and consistent behavior. Pay close attention here. A trader can be wrong many times and still be profitable as long as losses are controlled and winners are managed correctly. But a trader who loses control of risk even once can wipe out months or years of progress. This is why position sizing, risk per trade, and overall exposure are non-negotiable elements of success. They create stability, they create predictability, and they protect the trader from emotional decision making. Without risk management, trading becomes a controlled, probabilistic process. And this is one of the biggest mindset shifts required. Success is not about maximizing gains, it is about controlling losses. Because once losses are controlled, profitability becomes a function of consistency over time. Another critical component of trading success is psychological control. And this is where most traders struggle the most, even if they have a solid understanding of strategies and risk. The reason is simple. Trading is one of the few professions where outcomes are uncertain, feedback is immediate, and money is directly involved. That combination creates emotional pressure that is difficult to manage without structured discipline. Fear, greed, frustration, and overconfidence are not occasional challenges. They are constant forces that influence decision making, and if they are not controlled, they will systematically destroy performance. This is where most traders get it wrong. They believe psychology is about feeling confident or staying motivated. But in reality, trading psychology is about maintaining discipline regardless of how you feel. This is critical. Emotions will always be present. The goal is not to eliminate them, but to prevent them from influencing decisions. Professional traders achieve this by relying on structured processes. They do not make decisions based on how they feel in the moment. They follow predefined rules, systems, and frameworks that remove emotional interference. Now, this requires practice, it requires repetition, and it requires a willingness to accept discomfort. Because discipline often means doing the opposite of what feels natural. For example, cutting a losing trade quickly feels uncomfortable. Holding on to it feels easier. But the disciplined action is the correct one. And over time, these small decisions compound into either success or failure. This is why psychology is not separate from trading. It is embedded in every decision. Every trade is a test of discipline, not intelligence. And the traders who succeed are not those who feel the least emotion. They are the ones who act correctly despite it. Time and consistency are two factors that are completely underestimated in trading, yet they are essential for long-term success. Most traders approach trading with a short-term mindset. They expect results quickly. They want to see progress within weeks or months. And when that does not happen, they assume something is wrong and start changing everything. But this is where patience becomes critical. Trading is a skill that develops over time. It requires experience, pattern recognition, emotional control, and consistent execution. None of these can be rushed. Now, this is important to understand. Progress in trading is not always visible in profits. In fact, some of the most important progress happens before profitability is achieved. Improving discipline, reducing emotional mistakes, refining execution. These are all forms of progress that eventually lead to consistent results, but they require time. This is where most traders fail. They abandon the process too early. They look for shortcuts, they try to accelerate results, and in doing so, they reset their progress repeatedly. Professional traders think differently. They understand that consistency over time is what creates results. They focus on executing well day after day, regardless of short-term outcomes, and this is where the compounding effect begins. Small improvements in discipline, risk management, and execution build over time. They create stability. They reduce volatility in performance, and eventually they lead to consistent profitability. This is not exciting, it is not fast, but it is real. And if there is one thing to take away here, it is this: success in trading is not built on intensity, it is built on consistency. Now that the core foundations are clear, the next step is understanding the role of skill development in trading. Because success is not simply about knowing what to do, it is about being able to execute consistently under pressure. Trading is a performance skill, and like any performance skill, it requires structured practice, feedback, and refinement. You would not expect someone to become a professional athlete without training. Yet many traders expect to become profitable without developing their skills properly. This is where most traders get it wrong. They consume information, but they do not train execution. They understand concepts, but they do not build habits. And as a result, when it comes to real decision making, they fail to apply what they know. Pay close attention here. Knowledge without execution is useless in trading. The market does not reward what is understood. It rewards what is done consistently. Professional traders approach this differently. They treat trading like a craft. They focus on refining specific aspects of their performance: entry timing, risk control, emotional discipline, decision making under uncertainty. All of these are trained deliberately, and this process is not random. It is structured. It involves reviewing performance, identifying weaknesses, and systematically improving them over time. This is where the real growth happens, not in finding something new, but in improving what already exists. Small refinements repeated consistently lead to significant improvements over time. This is the difference between amateurs and professionals. Amateurs search for new answers. Professionals refine their execution. And once this mindset is adopted, progress becomes predictable, measurable, and sustainable. One of the most important shifts required for trading success is learning to think in probabilities rather than certainties. This is not just a concept, it is a fundamental way of interpreting every decision in the market. Most traders approach trading with a need to be right. They want confirmation, certainty, and validation before they act, but the market does not provide certainty, it only provides probabilities. This is where confusion begins. Traders expect a strategy to work every time, and when it does not, they assume something is wrong. They start changing their approach, abandoning their system, and searching for something better. But this is a misunderstanding of how trading works. Even the best strategies have losing trades. Even the most experienced traders are wrong frequently. The goal is not to eliminate losses. It is to ensure that, over a series of trades, the probabilities work in your favor. Now, this is critical. A single trade means nothing. It is just one outcome in a larger distribution of results. What matters is the consistency of execution across many trades. Professional traders fully accept this. They do not become emotionally attached to individual outcomes. They focus on the long-term expectancy of their approach. This allows them to remain stable even during losing periods, because they understand that losses are part of the process, not a failure of the system. This shift from needing to be right to thinking in probabilities changes everything. it removes emotional pressure, it creates consistency, and it aligns decision making with how markets actually behave. Another reality that must be understood is that trading is inherently simple, but not easy. The concepts themselves are not overly complex, but applying them consistently is extremely challenging. This is where most traders struggle. They overcomplicate trading. They believe that complexity leads to better results. They add more indicators, more rules, more variables, hoping to improve performance. But in reality, complexity often leads to confusion. It creates hesitation. It increases the likelihood of mistakes, and it makes consistent execution more difficult. Professional traders move in the opposite direction. They simplify their approach. They focus on clarity, repeatability, and discipline. Now, this is critical. Simplicity allows for consistency. When a process is clear and structured, it becomes easier to follow under pressure. It reduces decision fatigue. It improves execution. This does not mean trading is easy. Far from it. The challenge is not in understanding what to do. It is in doing it consistently, especially when emotions are involved. For example, sticking to a risk limit during a losing streak is simple in theory, but emotionally it becomes difficult. This is where discipline is tested. This is why simplicity is so powerful. It removes unnecessary complexity and allows focus to remain on execution. And ultimately, success in trading comes down to doing simple things well over and over again. Now let's address one of the most misunderstood aspects of trading success, and that is consistency. Because many traders believe consistency means winning most of the time, but that is not what it actually means. Consistency in trading is not about avoiding losses, it is about behaving consistently regardless of outcomes. This is a crucial distinction. A trader can have a series of losses and still be consistent if they followed their plan correctly, and a trader can have a series of wins and still be inconsistent if those wins came from breaking rules. This is where most traders get it wrong. They measure consistency based on results rather than behavior, and as a result, they reinforce the wrong habits. Professional traders define consistency differently. They focus on process consistency. Did they follow their rules? Did they manage risk correctly? Did they execute with discipline? These are the metrics that matter, because over time, consistent behavior leads to consistent results. Now, this requires honesty, it requires self-awareness, and it requires the ability to evaluate performance objectively. This is why journaling, reviewing trades, and analyzing behavior are so important. They provide feedback, they highlight patterns, and they allow for continuous improvement. Consistency is not something that happens automatically. It is built through repetition, discipline, and accountability. And once it is established, it becomes one of the most powerful drivers of long-term success. Another key factor in trading success is the ability to handle drawdowns, because no matter how good a trader is, there will be periods of losses. This is unavoidable, and how these periods are handled often determines long-term success or failure. Most traders react poorly to drawdowns. They become emotional, they lose confidence, they start changing their approach, they increase risk to recover losses more quickly, and this is where significant damage occurs, because these reactions are driven by emotion, not logic, and they often lead to even larger losses. Professional traders approach drawdowns differently. They expect them, they plan for them, and they manage them with discipline. Now, this is critical. A drawdown is not a sign that something is broken. It is a natural part of trading. The key is to determine whether the drawdown is within expected parameters, or if there is a genuine issue with the approach. This requires data, it requires analysis, and it requires objectivity. If the drawdown is within normal limits, the correct response is to continue executing the plan. If it is outside expectations, adjustments may be needed. But in both cases, the response is structured, not emotional. This ability to remain stable during difficult periods is what separates professionals from amateurs, because in trading, success is not defined by how well you perform when things are going well. It is defined by how you respond when they are not. At this stage, it becomes clear that success in trading is not about isolated skills, but about how multiple elements come together into a cohesive system. And one of the most overlooked elements in that system is decision quality. Every trade is a decision, but not all decisions are equal. Some are made based on structure, logic, and discipline. Others are made based on impulse, emotion, or external influence. And over time, the quality of these decisions determines overall performance. This is where most traders get it wrong. They focus on outcomes rather than decision making. If a trade makes money, they assume it was a good decision. If it loses money, they assume it was a bad one. But this is a flawed way of thinking. A good decision can lead to a loss, and a bad decision can lead to a profit. What matters is the process behind the decision, not the immediate result. Professional traders understand this deeply. They evaluate their performance based on decision quality, not short-term outcomes. This allows them to reinforce the right behaviors and eliminate the wrong ones. Now, this is critical if poor decisions are rewarded simply because they result in profit. They become habits, and those habits eventually lead to significant losses. This is why successful traders build frameworks for decision making. They define criteria, conditions, and rules that guide their actions. This removes ambiguity and ensures consistency. Over time, high-quality decisions, repeated consistently, lead to strong performance. And this is what separates structured traders from reactive ones. Another essential component of success is adaptability. Markets are constantly changing. Conditions evolve, volatility shifts, trends appear and disappear, and a trader who cannot adapt will eventually fall behind. However, adaptability does not mean constantly changing strategies. This is a common misconception. Many traders believe they need to adjust their approach frequently to stay relevant, but this often leads to inconsistency and confusion. True adaptability is more subtle. It is the ability to recognize changes in market conditions and adjust behavior within a structured framework. For example, during high volatility, risk may need to be reduced. During quieter periods, expectations may need to be adjusted. During strong trends, patience may be required. These are behavioral adjustments, not complete strategy changes. This is where most traders get it wrong. They confuse adaptability with instability. They abandon their system too quickly, believing something new is needed. Professional traders take a different approach. They build robust systems that can operate across different conditions, but have a bucket-weighting approach. And within those systems, they make measured adjustments based on context. Now, this is critical. Adaptability must be controlled. It must be intentional, and it must be based on evidence, not emotion. When done correctly, it allows a trader to remain consistent while still responding to changing environments. And that balance is essential for long-term success. Of the balance success, by one of the hardest truths to accept in trading is that effort does not always lead to immediate results. This is very different from most professions, where effort is directly linked to outcome. In trading, a trader can work hard, follow their plan perfectly, and still experience losses. And this creates a psychological challenge that many are not prepared for. This is where most traders become frustrated. They expect a direct relationship between effort and reward. And when that relationship does not appear, they lose confidence in their approach. But this is a misunderstanding of how trading works. Trading operates on probabilities, not guarantees, and outcomes are influenced by factors beyond individual control. Now, this is critical. The goal is not to control outcomes, it is to control behavior, because behavior is the only thing that can be managed consistently. Professional traders fully accept this. They focus on executing well, regardless of short-term results. They understand that over time, consistent behavior leads to consistent outcomes. This requires patience, it requires trust in the process, and it requires the ability to detach from immediate results. This is not easy. It goes against the natural instincts, but it is essential, because in trading, success is not about what happens today. It is about what happens over a series of disciplined decisions made consistently over time. Another defining characteristic of successful traders is accountability. This is often overlooked, but it plays a critical role in long-term development. Accountability means taking full responsibility for every decision, every action, and every outcome. It means not blaming the market, external factors, or circumstances for poor performance. This is where most traders struggle. When things go wrong, it is easier to blame something external. The market was unpredictable, the news was unexpected, the conditions were difficult. But this mindset prevents growth, because if the cause of failure is external, there is nothing to improve internally. Professional traders take the opposite approach. They assume responsibility for everything. If a trade goes wrong, they analyze it. They look for errors in execution, judgment, or discipline. Now, this is critical. Accountability creates awareness, and awareness is the foundation of improvement. Without it, mistakes are repeated. With it, mistakes become learning opportunities. This is why structured review processes are so important. They allow traders to evaluate performance objectively. They highlight patterns, and they provide a clear path for improvement. Accountability is not about self-criticism. It is about ownership. It is about recognizing that success and failure are both driven by decisions. And once that is accepted, improvement becomes possible. At a deeper level, trading success requires alignment between mindset, strategy, and behavior. If these elements are not aligned, performance becomes inconsistent. For example, a trader may have a solid strategy, but if their mindset is driven by fear or impatience, they will not execute it properly. Alternatively, a trader may have the right mindset, but without a structured approach, their actions will lack direction. This misalignment is very common, and it leads to frustration, confusion, and inconsistent results. Now, this is where alignment becomes critical. The strategy must be clear and structured. The mindset must support disciplined execution, and behavior must reflect both consistently. Professional traders focus on this alignment constantly. They ensure that their approach matches their personality. They refine their process to suit their strengths, and they build habits that reinforce consistency. This is not a one-time adjustment. It is an ongoing process. As experience grows, understanding deepens and adjustments are made, but the goal remains the same: to create a system where thinking, planning, and execution are all working together. When this alignment is achieved, trading becomes more stable, decisions become clearer, and performance becomes more consistent. And this is where trading starts to feel controlled rather than chaotic. At this point, it is important to understand the role of routine in trading success, because consistency in performance is almost always built on consistency in behavior, and that begins with structured routines. Most traders operate without any real structure. They check markets randomly, take trades impulsively, and review performance inconsistently, and this lack of structure leads directly to inconsistent results. Professional traders do the opposite. They build routines that govern how they approach the market each day. Preparation, execution, and review are all clearly defined. Now, this is critical. A routine reduces decision fatigue, it removes unnecessary variables, and it creates a stable environment for performance. For example, preparation may involve reviewing market conditions, identifying key opportunities, and defining risk parameters before any trades are taken. Execution then becomes a matter of following predefined rules, and review involves analyzing decisions and outcomes objectively. This structure creates discipline, it reinforces good habits, and it allows performance to improve over time. Without routine, trading becomes reactive. With routine, trading becomes controlled. And this is one of the simplest yet most powerful changes a trader can make. Because once behavior becomes structured, consistency follows. Another key element that separates successful traders from the rest is focus. Not just general focus, but focused effort on the right areas. Most traders spread their attention too widely. They try to learn everything at once. They follow multiple strategies, multiple markets, and multiple sources of information, and as a result, they make very little progress. This is where most traders get it wrong. They believe more information leads to better results, but in reality, too much information creates confusion and reduces clarity. Professional traders simplify their focus, they specialize. They concentrate on specific markets, specific strategies, and specific processes. Now, this is critical. Focus accelerates learning. It allows deeper understanding, and it improves decision making. For example, by focusing on a single approach, a trader can recognize patterns more effectively, they can refine execution, and they can build confidence through repetition. This does not mean ignoring everything else. It means prioritizing what matters most and eliminating distractions. Focus is not about doing more, it is about doing less, but doing it better. And over time, this focused approach leads to greater consistency, better performance, and a clearer path to success. Discipline has been mentioned throughout this video, but it deserves deeper attention because it is the backbone of everything in trading. Discipline is not about occasional effort, it is about consistent behavior, even when it is difficult, uncomfortable, or inconvenient. Most traders believe they are disciplined until they are tested, and trading tests discipline constantly. A losing streak tests patience, a winning streak tests restraint, market uncertainty tests confidence, and emotional pressure tests decision making. This is where most traders fail. They break their rules under pressure, they deviate from their plan, and those small deviations accumulate into significant losses over time. Professional traders treat discipline as non-negotiable. They follow their rules regardless of how they feel. They understand that consistency in behavior is more important than short-term results. Now, this is critical. Discipline is not built through motivation. Motivation is temporary. Discipline is built through habit and repetition. This means doing the right thing repeatedly until it becomes automatic. It means creating systems that support disciplined behavior. And it means holding yourself accountable for every decision. Discipline is what turns knowledge into performance. Without it, even the best strategy fails. And with it, even a simple approach can become highly effective. Another essential factor in trading success is emotional resilience. Because no matter how structured the approach is, trading will always involve uncertainty and stress. Losses, drawdowns, missed opportunities, and unexpected market behavior are all part of the process, and each of these can create emotional reactions. Most traders struggle with this. They become frustrated after losses, they feel regret after missed trades, they become overconfident after wins, and these emotional swings lead to inconsistent behavior. This is where emotional resilience becomes critical. It is the ability to remain stable regardless of external circumstances. Professional traders develop this over time. They learn to accept losses without frustration. They learn to move on from mistakes quickly, and they maintain a balanced perspective regardless of outcomes. Now, this is important. Emotional resilience does not mean ignoring emotions. It means managing them effectively. It means recognizing emotional responses without allowing them to dictate behavior. It means staying focused on the process even when outcomes are not favorable. This ability creates stability, it prevents overreaction, and it allows for consistent decision making. And in trading, stability is a major advantage, because while others react emotionally, disciplined traders continue to execute their plan. Finally, at the core of long-term success is persistence. Not blind persistence, but intelligent persistence. Trading is not a linear journey. Progress is rarely smooth. There are periods of improvement, followed by setbacks. There are breakthroughs, followed by challenges. Most traders quit during difficult periods. They assume the process is not working. They lose confidence, and they abandon their efforts. But this is where persistence becomes critical, because success often comes after periods of struggle. Professional traders understand this. They expect challenges, they anticipate setbacks, and they continue to refine their approach even when progress is slow. Now, this is critical. Persistence must be combined with adaptation. It is not about repeating the same mistakes. It is about learning, adjusting, and improving continuously. This creates a cycle of growth. Mistakes lead to learning. Learning leads to improvement, and improvement leads to better performance over time. Persistent is what allows this cycle to continue. Without it, progress stops, and this is one of the defining characteristics of successful traders. They do not give up when things become difficult. They use those moments as opportunities to improve, because in trading, success is not achieved by avoiding challenges. It is achieved by working through them. At a more advanced level, success in trading is defined by how a trader interprets the market, not just how they react to it. This is where professional thinking begins to separate itself from everything else. Most traders look at the market and ask a simple question: what should be done? But professional traders ask a different question: what is actually happening beneath the surface? This shift in thinking is critical. It moves the focus away from prediction and towards understanding. Instead of trying to guess what the market will do next, the trader begins to interpret behavior, context, and underlying drivers. Now, this is where most traders get it wrong. They search for certainty. They want confirmation before acting. But markets do not provide certainty. They provide information, and that information must be interpreted correctly. Professional traders build frameworks for interpretation. They analyze conditions, assess probabilities, and make decisions based on structured reasoning rather than instinct. This creates clarity. It removes guesswork, and it allows decisions to be made with confidence even in uncertain environments. The goal is not to predict perfectly. The goal is to understand enough to make informed, disciplined decisions. And this way of thinking is what transforms trading from reactive behavior into structured decision making. Another defining trait of professional traders is how they manage uncertainty. Because uncertainty is not something that can be eliminated in trading, it is something that must be managed. Most traders are uncomfortable with uncertainty. They try to reduce it by seeking more information, more confirmation, more signals, but this often leads to over-analysis and hesitation. Professional traders take a different approach. They accept uncertainty as a constant, and instead of trying to remove it, they build systems that operate effectively within it. Now, this is critical. Decisions in trading are made with incomplete information. There will always be unknowns. The goal is not to eliminate uncertainty, but to make the best possible decision with the information available. This is where risk management and probability thinking come together. By controlling risk and understanding probabilities, a trader can operate confidently even when outcomes are uncertain. This creates decisiveness. It removes hesitation, and it allows for consistent execution. Uncertainty is not a weakness in trading. It is a defining characteristic of the environment, and those who learn to operate within it rather than fight against it gain a significant advantage. Professional traders also understand the importance of efficiency, not just in execution, but in how they use time, energy, and attention. Most traders spend excessive time analyzing markets without improving their performance. They look at more data, more opinions, more signals, believing it will lead to better decisions. But this is often counterproductive because more information does not always lead to better outcomes. In many cases, it leads to confusion and indecision. Professional traders focus on what matters. They identify the key variables that influence their decisions and ignore everything else. Now, this is critical. Efficiency is about maximizing the quality of decisions while minimizing unnecessary effort. This means having clear processes, defined criteria, and structured routines. It means knowing when to act and when to do nothing, because doing nothing is often the most disciplined decision a trader can make. This is where most traders struggle. They feel the need to be active. They equate activity with productivity. But in trading, unnecessary activity leads to mistakes. Professional traders are selective. They wait for the right conditions. They conserve energy, and they execute only when it aligns with their plan. This efficiency creates clarity, reduces errors, and improves overall performance. Another key insight at the professional level is understanding that trading is a long-term game of survival and growth, not short-term optimization. Most traders approach trading with a short-term focus. They try to maximize profits quickly, they increase risk during winning periods, and they chase performance. But this approach is unsustainable because it introduces volatility, increases emotional pressure, and exposes the trader to significant risk. Professional traders think differently. They prioritize longevity. They aim to stay in the game, protect capital, and grow steadily over time. Now, this is critical. Survival is the first objective in trading. Without it, nothing else matters. This means managing risk conservatively. It means avoiding unnecessary exposure, and it means accepting that growth will take time. This long-term perspective changes behavior, it reduces impulsive decisions, it encourages discipline, and it creates a stable path to profitability. Because in trading, success is not defined by how quickly capital grows, it is defined by how consistently it grows without significant setbacks. And this mindset is what allows traders to build sustainable performance over time. Finally, professional traders develop a clear sense of identity in their trading. They understand who they are as traders, what their strengths are, and how they operate best. Most traders lack this clarity. They copy others, they follow external strategies, and they try to fit into approaches that may not suit their personality. This creates inconsistency, because when a strategy does not align with a trader's natural tendencies, it becomes difficult to execute consistently. Professional traders solve this by developing self-awareness. They identify their strengths, weaknesses, preferences, and limitations. Now, this is critical. Trading is not just about the market, it is also about the individual. A trader who understands themselves can build an approach that aligns with their personality. This improves discipline, reduces emotional conflict, and enhances execution. This process takes time. It involves experimentation, reflection, and adjustment. but it leads to a much more stable and effective approach, because ultimately, success in trading is not about finding the perfect system. It is about building a system that works consistently for you. And once that alignment is achieved, trading becomes more natural, more controlled, and far more sustainable. Now it is time to bring everything together into practical application, because understanding what it takes to succeed is only valuable if it can be applied consistently in real-world decision making. A professional trading process begins before any trade is taken. Preparation is where structure is established. This involves defining the conditions under which trades will be considered, identifying potential opportunities, and setting clear risk parameters. This is critical. Decisions should never be made in the moment without preparation, because in the moment emotions are strongest and clarity is lowest. Once preparation is complete, execution becomes straightforward. The trader is not searching for opportunities randomly. They are waiting for predefined conditions to be met. When those conditions appear, the decision is already made. The trade is executed according to plan, with predefined risk and clear expectations. Now, this is where discipline is tested. There will always be temptation to act outside of the plan, to take trades that do not fully meet the criteria, to increase risk when confidence is high. But professional execution means ignoring those impulses. It means following the plan exactly as defined. After execution comes review. Every trade is analyzed, not just in terms of outcome, but in terms of decision quality and discipline. This creates a feedback loop. Preparation, execution, review. Repeated consistently, this loop drives continuous improvement. And this is what trading looks like at a professional level. Structured, controlled, and process-driven. To apply this effectively, traders must learn to think in terms of scenarios rather than predictions. Most traders approach the market with a single expectation. They believe price will move in a certain direction, and they commit fully to that view. But this creates rigidity. When the market behaves differently, they struggle to adapt. Professional traders think differently. They consider multiple possible scenarios. If the market behaves one way, they will act accordingly. If it behaves differently, they have an alternative plan. Now, this is critical. Scenario-based thinking creates flexibility without losing structure. It allows a trader to remain prepared for different outcomes while still maintaining discipline. For example, instead of saying the market will move in one direction, a trader may define conditions under which they will take a position in either direction. The focus is not on being right, but on being prepared. This removes emotional attachment. It reduces bias, and it improves decision making, because the trader is no longer trying to force the market to match their expectations. They are responding to what actually happens, and this approach aligns perfectly with probability-based thinking. It allows for structured, flexible, and disciplined execution. Another key part of practical success is understanding when not to trade. This is one of the most overlooked skills, yet it has a significant impact on performance. Most traders feel the need to be active. They believe that more trades lead to more opportunities and therefore more profit. But in reality, unnecessary trades often lead to losses, because not every market condition is suitable for a given strategy. Professional traders are highly selective. They understand that capital should only be deployed when conditions are favorable. Now, this is critical. Patience is a skill. Waiting for the right opportunity is just as important as executing the trade itself. This means being comfortable with inactivity. It means resisting the urge to trade out of boredom, frustration, or overconfidence. And this is where discipline plays a major role, because doing nothing often feels less productive than taking action. But in trading, the opposite is often true. Avoiding low-quality trades protects capital and preserves mental clarity. This selectivity improves overall performance, it reduces drawdowns, and it increases the quality of decisions. Because in trading, success is not about how often trades are taken, it is about how well they are taken. As this video comes together, the most important takeaway is that trading success is not built on any single factor. It is the result of multiple elements working together consistently over time. Discipline, risk management, psychology, decision making, and structured execution all play a role, and none of them can be ignored. This is where most traders get it wrong. They look for a single solution, a perfect strategy, a shortcut to success. But trading does not work like that. It requires a complete system, a way of thinking, a way of acting, and a way of managing risk. Now this is critical. Success is not about perfection, it is about consistency. Mistakes will happen, losses will occur, but as long as the overall process is followed, progress will continue. Professional traders understand this. They focus on continuous improvement rather than immediate results. They refine their approach over time, and they build stability in their performance. This creates confidence, not from winning trades, but from knowing that the process is sound. And that confidence allows for consistent execution, even in uncertain conditions. Ultimately, what it really takes to succeed in trading is a complete transformation in how the market is approached. It requires letting go of the idea that trading is about quick profits or easy success. It requires accepting that it is a structured, disciplined profession that demands effort, patience, and consistency. This is not easy. It goes against natural instincts. It challenges behavior, mindset, and expectations. But for those who make this shift, everything changes. Trading becomes less emotional, less chaotic, and more controlled. Decisions become clearer, risk becomes manageable, and performance becomes consistent. This is the path to success, not shortcuts, not hype, but disciplined execution over time. And this is where most traders either separate themselves or fall behind. Because in the end, success in trading is not about what is known. It is about what is done consistently. If this is taken seriously, applied with discipline, and developed over time, trading can become a highly structured and rewarding profession. And if this video has shifted perspective even slightly, then that process has already begun.